Good morning, everyone. This is Katie Novotny from Premier's Long-Term Care Division. First and foremost, I want to thank everybody for attending this morning. We are super excited to have some really positive news on the LTC front. This morning, we are joined by Craig Rars, who is the head of marketing for Thrivent Long-Term Care's independent distribution. In his 22 years focusing on long-term care planning, he has helped thousands of agents market and discuss extended care planning for their clients. Today, we are absolutely thrilled to be announcing our latest addition to our Premier Long-Term Care Solutions, and this would be Thrivent Long-Term Care. Craig, you want to take her away?
All right. Well, thank you so much, Katie, and thank you everyone for your time today. I hope to deliver some really great information and another great solution for you to be offering along with all the other products that you're able to access through Premier. So today we're going to give you an overview of Thrivent's long-term care product, and you're going to have a really unique competitive advantage in being able to offer this solution to your clients right now. At a time when the strength and stability of a carrier are really important, because you're hearing in the news questions people have about the economy, about stock-owned carriers, things like that. Well, you're now going to be able to offer what I believe is one of the most benefit-rich of the standalone or traditional solutions that is currently on the market, that just so happens to be backed by the strength and stability of the country's largest fraternal insurer. So today I'm going to be working on the assumption that most of you are very well versed in most of the standard benefits and features in a long-term care policy. So the goal today for me isn't to walk through like a long-term care 101, but instead to really focus on where Thrivent's key differentiators are and show you where to position us. So first off, who is Thrivent? Well, we are the world's largest
fraternal.
Yes?
Can I interrupt real fast? I'm getting messages that we have no visual. Can someone send me a message, either chatting or through the questions area, that you can see Craig's screen?
Let's see here.
Okay, there it goes. It says we can see it now.
Okay. All right, sorry about that.
Thank you.
Okay, so back to who is Thrivent. So we are the world's largest fraternal organization. For those not familiar with what a fraternal is a not-for-profit organization where all of the members of that organization share a common bond. So with Thrivent, our members, their common bond is that they are Christian. So while it used to be Thrivent Financial for Lutherans, they did open their membership up much more broadly back in 2014. But a simpler way to maybe think of Thrivent is that we're more like a financial cooperative where all of the members or policyholders are owners. So we're not a stock company, and this is really important in that we're not beholden to stockholder interest every 90 days. So we're much more like a mutual company in that regard. And I actually like to talk about it as like a mutual plus. The plus being that unlike a mutual, for our not-for-profit tax-exempt fraternal status, we are required to give back to our community. So as such, we are the country's largest supporter of Habitat for Humanity. And you've very likely seen people out in Thrivent's Live Generously t-shirts like you see here on the screen, out in your community working on various service projects. So I'll share at the end of this presentation how to really easily and quickly have a discussion about the common bond requirement. And I save it only for the end because it's one of the very last things I want you to walk out of here with, is a very clear understanding of how to easily position Thrivent as a solution, especially if you're unsure of somebody's faith. So we'll get to that at the very end, but I did want to cover it up front. The common bond is that members are Christians. And just to clarify on this as well, Thrivent is not a religious organization selling financial and insurance products. We are a financial services company that serves members who are Christians. So it's a very important distinction. So Thrivent isn't going to be marketing anything like, sending out, biblical passages or things like that to people. They're not out preaching. They are a company that is just formed to serve a Christian membership. So with really strong ratings from AM Best, actually just last week, we were reaffirmed at A++ from AM Best. We also have an incredibly high Comdex. We're one of the few companies that is 99 out of 100 on the Comdex. And as you can see, we are the only one of the top 3 highest rated carriers that is available to independent brokers. So New York Life and Northwestern Mutual are also highly rated, but they are captive only. So what I'm going to share with you now is really a deep dive on some financial background, just so you understand how strong Thrivent is compared to other carriers. So one of the key measures of financial strength for a life company or a fraternal benefit society is what's called their risk-based capital. And what that is a company's actual capital. They take a formula and they determine the minimum amount that the company should be expected to hold based on how much risk it takes in its products and investments. So for example, a risk-based capital ratio of 300% would indicate that a company should hold 3 times the minimum amount of capital or surplus based on the risk that it takes in that. So for some perspective in our industry, from the most recent numbers that I could find, last year in 2019, Genworth, their RBC, their risk-based capital ratio, dropped below 200% for the first time. And from the most recent numbers I could find from others using Fitch, Mass Mutual had an RBC of 459%. Transamerica had an RBC of 471%. New York Life, 478%. According to Fitch, Thrivent has one of the highest risk-based capital ratios in the industry at 750%. So just hearing that, they're really at this time when people are concerned about the economy, I don't believe there's any company better suited to weather just about any financial storm than a company like Thrivent Financial. So you might be asking, well, isn't Thrivent new to long-term care? Well, yes and no. So Thrivent began as 2 separate fraternals. Those of you who have been doing long-term care for a while are probably familiar with some of our predecessor organizations. One is Aid Association for Lutherans, or AAL, and the other is Lutheran Brotherhood. And both of those companies began selling long-term care back in 1987, when many carriers got into the industry. And those 2 companies both sold their own products up until they merged in 2001, at which time they formed a company called Thrivent Financial for Lutherans. At that time, Thrivent was busy getting all of their other products off the ground, their life, their annuities, their med subs, things like that. So they didn't have their own long-term care solution for a number of years. And during that time, they represented some other leading carrier solutions. But because we so firmly believed in solving this problem for our members, we re-entered the market with our own product in 2012. That one was repriced in 2014, as you can see. And we are now on our 2nd generation of product, this one being launched in 2016. So if you think about it, Thrivent has the benefit of over 30 years of experience in long-term care solution for our members, but without perhaps some of that baggage that might come with some of the missteps that other carriers made with things like pricing, underwriting, and other assumptions made in the 90s, late 90s, and early 2000s. So with AAL being formed in 1902 and Lutheran Brotherhood in 1917, you're actually working with an insurer that has roots that go back over 100 years. So we are a very old company in that regard, but our current long-term care product is actually fairly new. And when we're also talking about this, because it's a 2016 product, our pricing is much more current than some of the other leaders out there in our industry right now. Just something to keep in the back of your mind when you're looking at solutions. Some of the others haven't been repriced since 2013. So there have been some increases on those old blocks of business from AAL and Lutheran Brotherhood, but as you can see, and as you'll see in the outlines of coverage, these are much smaller than rate increases that you've probably seen on business sold by some of those stock-owned companies during those same time frames. And there have been no increases on the Thrivent branded products that are available since 2012. And if you average all of these out and you look at them across all the various states, I believe the actual percent increase came out to about a 23% average increase on any of those old blocks of business. Put that into context, some of those high double digits that you've seen from some of the other past leaders in our industry, and some of them have even had triple digit increases. So Thrivent has always been very conservative, and they've always work on things with their members' best interest in mind. They don't want to do anything that's going to impact their owners. So real quick, just for your understanding, for underwriting and claims processing, we have teamed with one of the most experienced partners out there, LTC Group, which you're probably familiar with because they serve many of the other leading carriers. They have a great pre-screening, pre-qualification line that you can contact to pre-qualify your clients before submitting anything. So they're a great partner for us in that regard. And just so you understand where we currently sit. So these are LIMRA's 2019 end of year numbers, and I just wanted you to see the current landscape of providers. So with Genworth's exit, mutuals and fraternals now represent the bulk of traditional long-term care sales. And as you can see here, Thrivent is currently the 6th largest standalone long-term care insurer. And with that being said, most of that up until the past year or two have been from Thrivent's 2,300 career reps selling products. So now that it's opening up to independent brokers like yourselves and through groups like Premier, we expect Thrivent to grow dramatically this year. So real quick on this slide, I'm going to share some of the key differentiators that we're really going to dive into on the following slides. But these are some areas where we really do differentiate from some of the others in our industry. So first off, we cover issue ages of 18 to 79. As you know, many other carriers now limit this to ages 40 to 75, so we can cover a lot more on either side there. We have a built-in 5-year rate guarantee. Most carriers no longer offer a rate guarantee, or if they do, it's maybe a 3-year maximum. Our elimination period already has a built-in shortcut. Instead of the 1 day of service equals 1 day of credit towards your elimination period, we have a built-in shortcut of 1 day of care in a week, satisfying that entire week towards your elimination period. We also have another shortcut that you can add by adding a 0 day for home care that we'll get to in a bit. We have up to an 8-year maximum benefit. As you know, other carriers might not offer anything over maybe a 5 or 6-year benefit. We'll go all the way up to a $15,000 a month maximum. Other carriers might max out at $9,000 or maybe $10,000. Then we offer some great options when it comes to adding inflation. We have what you're going to be most familiar with, your compounding inflation of 1%, 2%, 3%, and 5%. With Thrivent, we call that an automatic inflation benefit. But we also have an option called a flexible increase benefit that's going to give you more flexibility in plan design, and we'll discuss this one a lot more in depth because this one is a little detailed. We are one of the few standalone carriers that offers a 10-pay, an accelerated payment option. And then we also have some great riders that you can tag onto our product. We have an additional cash benefit rider, we have a shared care option, we have survivorship, and we have a return of premium. So as you'd expect in a modern traditional long-term care policy, Thrivent covers services and care in a variety of settings, including home care, residential care facilities, adult daycare, really giving your clients the flexibility to receive the level of care that they need in the location they most prefer. This product is eligible to receive dividends because we are a fraternal. So like a mutual, we're designed to, give back to our policyholders when possible. However, these dividends are not guaranteed, and the dividends, if they are payable, are going to be applied on an annual basis. And with Thrivent, there's only one dividend option available on their long-term care product, and that is to reduce future premiums. So we don't really use the dividend availability as a selling point because it's not guaranteed. And to date, just for your reference, no dividends have yet been paid on the 2012 or 2016 products. And that's not to say they won't be, they just haven't at this point yet. They're still fairly new products. The contract is intended to be federally tax qualified, and it has been designed to be partnership eligible where available and where they have filed this as a partnership product. And this product is available in all states except for New York. And I always get questions on that, whether we're going to be filing this at any point. There are no plans at this time to file a product in New York. So Thrivent's product has a lot of great built-in features as well as some really nice optional riders. So we'll kind of cover this now in those two buckets to help keep things straight. First off, let's talk about some of the built-in features. One of the first I always talk about is our built-in waiver of premium, where once the elimination period is satisfied, or if you have a couple that applies together and has shared care, there's going to be a double waiver of premium, even if only one of them is receiving benefits. Thrivent has a built-in care coordinator service. So the clients are not required to use care coordinator services in order to use their insurance benefits. But I always talk about this. I think it's one of the most under-talked about, but one of the most beneficial features in a long-term care policy, because when it comes time for claim, this is one area that helps out families immensely, is being able to tap these kind of resources to help them put that plan in place. So while you're not required to use the care coordinator services to use your benefits, it's highly encouraged to use this if at all possible. One of the reasons being expenses for this service is not going to be reimbursed from your contract coverage. It's not going to ding your benefit pool. These costs are covered separately by Thrivent, because Thrivent so firmly believes in the value of care coordinators that this is kind of a freebie, if you think of it that way. So Thrivent covers these costs separately. You're not going to be draining your pool quicker by using this. So to help with emerging services and technologies, an alternate care provision is included with all Thrivent contracts. We also offer bed reservation in a facility for up to 60 days per calendar year. And we have a contingent non-forfeiture benefit in the event of a substantial premium increase. And those numbers, the levels for that are all going to be included in the application and outline of coverage. So now let's talk about what we call ancillary benefits. These are, again, included in all contracts, and these are going to be things that are things like respite care, equipment and home modification, caregiver training, and an international care benefit. So each of these is going to be equal to 2 times your maximum monthly benefit amount. So it's not 2 times total for all 4 of these things. Each one of these has 2 times your monthly maximum as the amount for it. So it's going to be 2 times for respite care benefit, 2 times for caregiver training, etc. These are not subject to the elimination period or your maximum monthly benefit. Ancillary benefits, if you use these are not going to satisfy your elimination period. Ancillary benefits that are paid are going to reduce your total benefit pool. And again, each of these has their own separate benefit limit amount. And the reason I'm saying that again is because when we get down to the international care benefit, first off, international care is going to be any services that are received outside the US, our territories or possessions, and it's going to cover any countries except those that are excluded by being, subject to UN treaties or UN sanctions, I believe. So the reason I bring up that 2 times cap here is because when it comes to international care, if that is extremely important to your client, Thrivent might not be the best solution for them, just because I know there are other providers where you can get up to a year of international care benefit. So if that's really, truly important to your client, we might not be the best fit. I just like to be really transparent there. So let's talk about the basic building blocks of a policy. And here again, we're going to focus some time because Thrivent, again, differentiates from competitors in this area. So first off, elimination period options. We can do 30, 90, or 180 days. And again, instead of the actual service days that some plans offer with Thrivent, if you have just 1 day of care in a week, it's going to satisfy that entire week towards your elimination period. And it only needs to be satisfied once while your contract is in force. While others might cap out their monthly maximum at $9,000 or $10,000, Thrivent will go all the way up to $15,000 a month in increments of $100. So we can design some really robust plans here. And the same with benefit multipliers. We can do 2, 3, 4, 5, and 8-year plans. And so again, we could design some really robust solutions for people, especially with the 8-year plan. We can add shared care to that. You can essentially have a 16-year combined pool for a couple, which I like to always pitch as the next best thing to an unlimited policy. So now let's talk about some of the optional riders, because these are some of those final choices that you make when you're working with a client. Again, you're going to be able to do a lot of additional customization here. So first off, how do you design a policy to grow, over time to accommodate the cost of care? So Thrivent, we offer 2 different types of benefit increase options. First, a flexible increase benefit. This is a 5% compound option, a buy up each year that we'll discuss really in detail here. And then again, annual increase benefits of 1, 2, 3, or 5% compound. So first, let's look at the flexible increase benefit. This one is available to applicants who are ages 18 to 70. And what it's going to do is it's going to provide an opportunity to increase your maximum monthly benefit amount and whatever is left in your total benefit pool on your contract anniversary by 5% compounded annually. And what it is it's an all or nothing offer each year that does not require any evidence of insurability. So this increase is going to be automatic on your contract anniversary unless the insured opts out when he or she receives the annual notification letter. So that's very important. It's not an opt-in that they have to remember to do, it's an opt-out. So premiums are going to increase with each offer that is accepted and will be based on the insured's age at the time of the increase that they take. The premiums are going to remain unchanged if the insured does not accept an increase. So knowing that the 5% compound option, if you go this route with the flexible increase benefit, it's going to be much more expensive than if you had just purchased a 5% compound inflation on the automatic increase benefit side, just because that one has level premiums and the prices are built into that, or the increases are built into that one. Here, you're buying up those little 5% increments at your attained age. So it's going to be much more expensive in the long run. These automatic increases are going to occur, though, if the insured is on claim. And I'll show you how that becomes important in just a second here. You're probably wondering, what are the rules about somebody being able to decline this offer? Well, if 3 consecutive offers are declined, at that point, no future increase offers will be extended. However, the rider is still going to remain on the contract because, as I mentioned just a little bit ago, since the insured is still eligible for the automatic increases that occur when they go on claim. And you'll actually see how that plays out on the very next slide here. So let's walk through a hypothetical scenario. Sorry, I got to grab a drink here. One moment. All right, sorry about that. So we have a client. Her name is Mary. She buys a policy when she's 50 years old. And she chose the optional flexible increase benefit, or FIB, because it helped manage her budget, since the premium increases were really going to be dependent upon her choice to accept or decline an offer. And for her, this was going to be important because she knew during part of this time frame, her children were going to need help paying for college. She was going to have some other outlays that she was going to need to account for. But at the same time, she also knew that in order to be prepared for the future, she wanted her maximum monthly benefit amount to increase over time. And her initial goal with this, when she met with her planner, was to accept increases whenever she could, up until her benefit amount reached at least $15,000 a month. So over the next 20 years, Mary accepts 13 annual increase offers. They're in red on the screen. And she declines 7 in the dark gray. However, as you can see, since she didn't decline the offer in 3 consecutive years for a while, that meant her flexible increase benefit continued to be offered each year. Flash forward to age 70. At this point, Mary decides, after reviewing everything, that her maximum monthly benefit is now about $15,000 a month, and she thinks this is still adequate to meet her future needs. And at this point, she decides she's going to decline all future increases. So at this point, she declines the increase offer 3 years in a row, and she is not offered any future increases. So that's where you see the 3 dark bars, dark gray bars there on the screen. Jump ahead a little bit further in time, we get to age 80. At this point, unfortunately, Mary's health goes downhill and she needs to go on claim for long-term care. At this point, the FIB automatically kicks back in, increasing her maximum monthly benefit and whatever is left in her benefit pool by 5% compounded annually, and it will continue to do so each year while she is receiving care. That's why you see it starting to tick back up in red there at the end. But the big difference here is Mary doesn't have to worry about paying premiums on this because the waiver of premium is a standard feature built into her insurance. So she's getting all of these increases, but she's not having to pay for them at this point. And in the illustration software, you can really show how the different pricing scenarios can play out based on how a client might want to do this. Somebody might say, okay, I want to only take every other year. I want to take every third year. You can really dial in all these changes. You can really customize it, by what ages they take it at even. A key thing about the FIB, this option can be partnership qualified, dependent on age, in 26 states, as long as you meet the buy-up requirements for that state. And it does vary from state to state. And so we'll be providing Premier with a full list of partnership requirements that they can share with you as a follow-up to this call. One example might be a state would require someone to accept all FIB offers up through age 75. I'm using that example. That's Minnesota's rules around the FIB. I live here in Minnesota. And in that example, if she had to accept all offers up through age 75, Mary's policy would have lost partnership qualification after she declined that first offer at age 57. So the FIB is a good solution for those who have annual reviews with their clients. That's why it's one of the most popular options with Thrivent's career agents, because they do have these annual reviews. And the reason for that is you want to make sure that someone understands the need to continue buying up, either to maintain a partnership status or to just keep growing their benefits. So it's not a set it and forget it kind of solution. That kind of solution is more what you're probably more accustomed to. Our annual increase benefits are what we call them, but it's your traditional compounding inflation options, where the maximum monthly benefit, your available pool of money, and any ancillary benefits are automatically going to increase annually on your rider anniversary. The difference here, again, being premiums are going to remain level over time. And that's because those costs of the future increases are automatically baked into the premium. So as a result, this benefit is going to be a lot more appropriate for people who just want the convenience of making one decision, whether it's the client wanting to make just one decision, or if it's as a producer, it's just easier for you and it's going to benefit your client. It's sometimes just an easier decision to make that way. Or for those who want, a level premium just for their budgeting purposes, it's sometimes easier to look at this kind of solution than at the FIB, where it's really going to be dependent on how many of those increases you take and how often. So now let's talk about some of the optional riders. And if I mention some cost percentages here, these are all ballparks that can be impacted by various factors, things like elimination period, marital status, risk class, and things like that. And I will be getting Katie a list of these ballpark costs for these riders. But I just want you to know that those can vary based on some of those factors. First off, we have a cash benefit that is available with Thrivent. So this cash benefit is going to be different than some of the others that you're seeing out there, where those are an alternate cash benefit usually, where it's maybe a third or 40% of your policy would be paid as cash in any given month versus getting 100% if you went the reimbursement route. That is not what we're talking about here. This is an additional cash benefit. So in addition to getting your 100% reimbursement in any given month, you're also going to receive an additional cash benefit pool. And this is going to help somebody pay for services not typically covered, help them pay for things like informal caregivers, stuff like that. So the insured is going to receive an additional 15% of their maximum monthly benefit paid as cash if they are receiving home care services, Or if they are receiving facility care, the cash benefit is going to be equal to 10% of the maximum monthly benefit. And the cost of this one is, this is not going to draw down your benefit pool quicker if you have this. The cost of this is an additional cash benefit. This is paid by Thrivent separately. So you're not going to draw down that benefit pool quicker by having this rider. The cost of this rider is about 16% additional premium. So your clients don't want to use it or lose it. A big concern and a reason a lot of people look at linked benefit solutions these days. Well, we can design policies to compete with those. So one way to do that is by adding the non-forfeiture benefit rider. Here it's going to provide a paid up benefit equal to whatever premiums they paid in up to the point that they decide to terminate their coverage. The contract must be enforced for a minimum of at least 3 years before this benefit can be triggered. And the cost of this option is about 8%. There's also a return of premium upon death rider, where it's going to return the premiums paid up to that point, minus any claims paid, to the insured's estate at the time of death. A key thing here is the rider must be enforced for at least 10 years before death occurs to be eligible for payment. So that being said, this is going to be one of the more affordable return of premium options that you're going to find out there because of that requirement of being enforced for 10 years. The cost of the return of premium does vary with issue age, but just a couple of examples. It runs about 25% for somebody age 50 to about 49% for somebody age 65. So what about riders for couples? Well, we do offer a shared care rider. This is going to link together 2 individual contracts. So this is not a third pool concept. It's going to combine 2 benefit pools. And again, it's designed to provide couples with some of that extra flexibility in their planning. And if an insured uses his or her entire available benefit, then he or she can start drawing from their benefit partner's remaining available benefit. So again, if you couple this shared care with an 8-year benefit each, you have a 16-year shared pool between 2 people, probably the next best thing to an unlimited benefit. What happens if one spouse uses all of the healthy spouse's benefit? Well, at that point, the healthy spouse can then elect to purchase a 2-year benefit for his or her use only. For that option, no evidence of insurability is going to be required, and the new premium will be based on the insured's attained age at the time that they do this. And this is going to be an option available for people up through age 85, just because they do realize that a lot of claims happen in 70s and 80s. And so if both pools got drawn down, you do want somebody to be able to buy a 2-year benefit at least to be able to serve their own needs. What happens if one of them dies? Well, if an insured dies, whatever is left in their benefit pool is going to be automatically added to the surviving benefit partner's contract. The cost of that shared care rider, though, will be dropped from the policies, but the spousal discount will remain in place for the survivor. Now, the cost of the shared care, this one does vary with benefit multiplier, but again, in some examples, it runs about 25% to combine 2 3-year plans and about 16% to connect 2 5-year benefits. We also offer a survivorship benefit, where if a couple has in-force contracts and riders for 10 years and one dies, the surviving benefit partner's contract will become fully paid up, and the cost of the survivorship runs about 10%. So what about faster access to benefits? Well, if your clients want to make it easier for their future caregivers, they might look at adding a 0-day elimination period by adding the waiver of elimination period for home care and adult daycare. And as I mentioned earlier, we already have a built-in shortcut of the 1 = 7, but here you can go right to a 0-day for home care. Any days received under this benefit, under this rider, are going to be applied towards meeting the elimination period. So when facility care is needed, the elimination period isn't going to have to start over, for example. And the cost of the waiver of elimination period with Thrivent, I think, is one of the more affordable ones out there, as it runs about 7%. When I've looked at some of the other carriers, they tend to be in the 9 to 10% additional cost range. So again, here's another spot where you can add some value to your clients a little bit easier and more affordably than with some other carriers. So Thrivent is one of the only carriers that is currently offering a 10-pay option on the standalone side. Here, there is going to be a reduction in commission for you, the agent, and this is not going to be available if you choose the flexible increased benefit option or if you go with the survivorship rider. One thing you do need to know going into this is Thrivent doesn't wish to become a 10-pay only carrier. We do want to have a nice balance of business, and so our actuaries actually want this to represent less than about 10% of our total business. That being said, it currently is about 5 to 7% of the business that is being done by Thrivent, so there is room for growth here. But because they don't ever want it to be like half their business, they do have a stipulation on this right now where if you have 3 or more people that you're going to be submitting at the same time for 10 pays, those kind of cases do need to be pre-approved by Thrivent. There's an email address that will get to Katie that you just send an email to them saying, here's the scenario and here's the cases that I'm going to submit, and then Thrivent would look at those and approve them. In the 5 years that we've been offering this to independent brokers, they have not turned down a single one of those requests. So it's more a formality right now. And what I mean by 3 or more people being submitted at one time is it's not like you have 3 unrelated cases, all 10 pays in any given month. It's if you have maybe a small family-owned business where they're going to be paying the premiums through the business, they're all doing 10 pays, and everybody in the business is going to meet that common bond requirement. Those are the kind of situations where it does need some kind of pre-approval. So they're all being submitted kind of at one time, but they're all under this, this certain scenario. It's nothing to be alarmed about. Like I said, there is room for growth there. There is just that formality that we have to work through. So let's now talk about some potential discounts. So first off, when you have somebody who is in really great health and their underwriting is going to get them a preferred health discount of 10%. However, with only 25 to 30% of our policies currently being issued preferred, I always encourage people, standard should be the standard when quoting, especially if you're not sure. Just because, as you know, it's always easier to go back and tell somebody they got a discount because they're so healthy than, hey, you know what, we need some more premium from you. Thrivent actually, here's another differentiator. In our underwriting guide, we actually have a really great preferred health checklist. So I know not all carriers give a really clear-cut indication of whether somebody's going to be preferred or not. We have a pretty good guide in our underwriting guides. So take a look at that. You can also contact our pre-qualification line at LTCG at any time, bounce the health off of them, and they will give you a thumbs up or thumbs down. They'll tell you whether somebody's going to be rated or not, but they'll also tell you whether somebody should get preferred issues. So they're a great resource as well. So 10% preferred health discount. We also have 2 types of couples discounts. We have a 20% couples discount, where both individuals apply and are approved for coverage, or where just one individual already has existing coverage that is either issued by Thrivent or one of those predecessor fraternals, AAL or Lutheran Brotherhood, and the other person is now applying for Thrivent coverage. So if that kind of situation comes up, the new applicant is going to get that 20% couples discount. And if it's a Thrivent policy, that couples discount will be applied to the person who already owns a older Thrivent contract on their next policy anniversary. A 5% discount is available if both individuals apply, but only one is approved for coverage, or if you have just one person in a couple who is applying. So who qualifies for that couples discount? Married couples, civil unions, domestic partners, same-sex couples are allowed with Thrivent. And we also allow if you have just two individuals who are living together for at least 3 years in some kind of committed relationship as partners or family members and are committed to sharing expenses, are not married, and if they're related, they have to belong to the same generation. So usually siblings, and where we often run into it here in the Midwest anyway is a lot of scenarios has been you have two bachelor farmer brothers living together on the family homestead after mom and dad retire. They're still running the family farm. They're living in the house together. They're sharing expenses, obviously not married, and they are related and they belong to that same generation. Those two brothers can get that couples discount with Thrivent. So let's talk about some sweet spots. Now, not all of these are absolute. These are just general areas where you should be looking. But singles were really good, especially men. That return of premium, because it's priced to only pay out if it's in force for 10 or more years, that return of premium is going to be a lot more affordable than with other carriers. We're really competitive with younger couples, not just on pricing, but because we can also insure some younger couples that others might not be able to. High net worth or affluent clients, whatever you want to call them, they often are attracted to Thrivent's product because of these robust policies that we can design. That, again, that higher monthly benefit amount and the longer benefit period mean you can design some policies. I don't know what all of you call them, but back in the day, we used to call them Cadillac plans. You know, you can design an 8-year plan, but shared care on it. 5% compound inflation if you want, $15,000 a month. That is unheard of at, you know, being able to design something that rich. So if somebody wants something like that and they can afford it, we do offer it. We're really competitive when you compare against other 5-year benefits out there, and you'll be able to, we are in Stratecision software, so if you use that at all, you can play around with us side by side with other carriers. Again, more ages, 18 to 79 means a lot more people can be covered here. We have that 10-pay option. When carrier strength is important, we should be like one of the first carriers you consider. And then finally, some underwriting niches. And these are some things that our team has discovered, and I'll get a list of these to Katie to share with you. I could not put these in the slides here because the underwriting stuff I'm going to share with you has not gone through compliance, but this is what our team has discovered. So these are all, I always caution people, always go to whatever the underwriter pre-screeners tell you or the underwriting guide says, but this should give you an idea of some areas to look. And before I get into this even, one other thing I want to share with you is because we are member owned, again, we are so protective of what happens to our policyholders. So right out of the gate, when COVID-19 got to be serious, Thrivent was one of the very first companies to extend their grace periods on premium payments, and we did that out to July 30th at the very minimum, and we're taking a look at whether that needs to be extended depending on what happens with the world. But again, we're very protective of our members. So a few things on the underwriting case management side, a few highlights. Again, there's that preferred health checklist to give you a really clear indication of what rate somebody should come back with. We have preferred, standard, and we have two substandard, class 1 and a class 2 option. We'll look at a history of severe anxiety or depression that's been stable for a number of months. All of that, again, is going to be in the underwriting guide. Take a look at us for conditions like arthritis, AFib, or heart bypass. Cancer, it's going to vary, but we break it down 6 different ways, you know, looking at things like stage, treatment, and stability. But we will, for example, look at up to a stage 4 Hodgkin's diagnosis. Crohn's disease is something that Thrivent will consider, regardless of whether it's a single or a multiple flare. For diabetes, A1C can be up to 8.5, depending on when it was diagnosed and the stability of meds and or insulin. And we don't list a maximum amount of insulin. You're going to need to take all that information and bounce it off the pre-qualification line. And then here's a big one. We don't decline based purely on family history of cognitive impairments. I know another carrier does, a leading carrier does decline based on that. Thrivent does not. We also don't decline just based purely on other carriers' declines. That doesn't mean we're going to insure somebody that's, everybody else is going to turn down, but we will take a look at them. Again, in those instances, pre-screen that client with LTCG through us, and they will give you an indication of whether you should submit it or not. So don't just throw something at the wall, see if it sticks. Contact the underwriters and have a discussion with them. And then last, and certainly not least, especially not right now, Thrivent is continuing to accept all applicants, all applications on all of its pre-COVID issue ages. So again, 18 to 79. I know other carriers have said, we're not going to take anybody over age 70 for the time being. We're not going to take anybody over age 65 for the time being. Thrivent is continuing to issue up to age 79. So here's how that works. For clients that are under age 70, no face-to-face interview is going to be required, provided that the client has seen a doctor and had labs done in the past 2 years. So in any cases where it's somebody age 70 or above, they're going to need a face-to-face, or at underwriter discretion, they might occasionally order that. Thrivent is not going to waive that requirement. So if they cannot locate a nurse to go in and complete the assessment, or maybe if the applicant doesn't want somebody to come into their home, they're not comfortable with that right now because of coronavirus, to complete the face-to-face, well, at that point, then the application is not going to be able to proceed. But if you have cases with people under age 70, with clients, who've seen a physician in the last 2 years, we're going to be a good choice to explore, given that we're still accepting those applications and they would likely not require that face-to-face interview. And we understand that many applicants have concerns about face-to-face right now, so that age-based requirement should be discussed with anybody before even starting an application. Don't get all the way through the process and then say, okay, so the next step is, and then have them say, I'm not comfortable with somebody coming into my home. Have that discussion before you even start the app. But again, it's a great, we're seeing tremendous growth right here, right now, because of changes other carriers have made. And I'll get some of these underwriting notes to Katie to share with people, as well as underwriting process brochure that really does detail by age the requirements for things like that. We are becoming a very user-friendly carrier. Again, we were built to serve career network at one point, but now we are growing and we're trying to continue to adapt to everyone's needs to sell virtually, sell easily online, things like that. So one of the things that we now offer is a illustration software that is built in. Well, first off, it's got data entry all from one screen, so you don't have to toggle through multiple screens, which is kind of nice. But also, we have a built-in cost of care tool. So I know a lot of people who do sell remotely, they have, a cost of care tool open up at the bottom of their screen, minimize, and they have to jump to that and then go back to whatever they're doing. We have it built right into our software. And this is based on LTC Group's cost surveys using some current data. So again, a great tool for those who do remote selling. And this software is all built into our e-app, which I'll get to in a moment. The illustration software. So even though you can run some comparisons in something like Statistician, you do want to use the full illustration software when you're actually meeting with the client. And that's for a couple of reasons. First off, it lets you show the impact. If you're choosing the FIB option, you can show how that actually plays out. Like on the example on the screen, if somebody just decided they wanted to do this every 3rd year, that they would select the next offer, you can illustrate that. You can run different scenarios. The customized option you see at the bottom of that drop down, that's the one where you can choose whatever ages that somebody might take it at. So you can really dial this in to show them how this can, play out. The other reason to use the full illustration software is this does give them an idea of how the dividend might play out. So again, while the dividends aren't guaranteed, if somebody does want to see, well, what does that mean to me? You can show them, okay, well, here's what your premium would be, here minus the dividend, here's what your actual premium outlay would be, and here's, what your maximum monthly benefit would be at that age, here's the available benefit, things like that. So again, it's not guaranteed dividends, but it's a way that you can show them that if they are interested in that. So we are currently working with Katie's team at Premier on getting this finalized in their iGo platform, the eApp. Again, if you use eApps for other carriers, you're really going to appreciate how easy this one is to use, and also that it does what all eApps do. It reduces the cycle times, make sure you don't have anything missing signatures, things like that. 100% legible forms, better customer experience, and again, you can do this all with somebody remotely across the country. So it's a great tool to have, and with the illustration software being built right into this, you can pre-populate about a quarter of the app just based on the illustration. And I do encourage everyone to use the eApp if at all possible, because I will be very blunt here. Thrivent's actual paper app is heavy on the paper. It's probably about 60 pages per applicant. So you have a couple, we're talking about 120 pages. That is something we're trying to reduce and get into a combined joint application on our next generation of product when that is, comes available at some point. But right now, it is a monster. I'm not going to lie to you. So I encourage everybody when they're starting out with Thrivent, if at all possible, try the eApp. So I'm going to get to our two biggest questions on product. Second biggest question we always get is, how does Thrivent compete on price? Well, when you're competing against the cheapest products on the market, we can be competitive. But where we really shine is when you actually change the conversation to be about company strength, not what's cheapest. As those of you who have been doing this for a while, what's cheapest doesn't always remain the cheapest if that company has rate increases down the road. So we talk about company strength. And what we've done here on the screen, and this is in StratDecision, we ran a comparison just on the top 4 highest rated traditional carriers. So only A++ rated, Comdex of 98 or higher. And as you can see, we have 2 that are available through captive distribution, Northwest Mutual and New York Life. And then 2 recently made available to independent producers like yourselves, Mass Mutual and Thrivent. So trying to stack everything up as much apples to apples as I could. I took a look at married couple, male and female, both age 57 in standard health. I looked at $4,500 a month, 3-year benefit, 3% compound inflation because I didn't want to overwhelm somebody. And then all things being relatively equal with Thrivent, we still added in our 0-day for home care because first off, it's not available with all the others. And we also added our shared care benefit. The other 3, you can't even get shared care with standard rates. I mean, New York Life does offer shared care, but it's only going to be with preferred issue. So as you can see, when you are comparing just against the highest rated insurers out there, not only is Thrivent competitive, but you're actually getting quite a bit more bang for the buck. So now to the biggest question we get on Thrivent. So as we discussed at the beginning, Thrivent is a fraternal organization that was designed to serve Christians. So as such, there is one and only one Christian-related question on the application. And it's one of the very first questions that people get so they don't get halfway through the app before knowing whether they qualify or not. And the question itself is very simple. It's just this, as you see on the screen. Select one of the following. I am a Christian seeking to live out my faith, or I am the spouse of a Christian who seeks to live out his or her faith. So that's it. There's no questions about what church someone goes to, how often they go, anything like that. And because of how Thrivent has worded this question, we've actually had people from mixed faith marriages, or even people without faith at times, get coverage with us as long as they were married to a Christian living out his or her faith. And with a national survey recently showing, I believe it was the Pew Foundation that did this, showing that 70% of the American population self-identifies as Christian, odds are many of your clients would probably be eligible to apply for Thrivent membership and coverage. So how do you position Thrivent as an option with your clients, especially if you're not sure of somebody's faith? So we've been using this approach now for 5 years with independent brokers, and it really tees up Thrivent as an option by putting your client in charge of whether you can proceed in the conversation or not. And these, I call these the magic words here. We'll get this to you in a piece called Thrivent 101. It talks about fraternals, how they operate, how you can explain it to people, but it also has this wording so you don't have to try to walk out of here today memorizing it, but you want to keep it as close to this as you can because it works, and it does it in a way without being offensive to anybody. So you just say to somebody, you know what, I have a few different solutions that I'd like to discuss with you. One of these is from a fraternal benefit organization called Thrivent. And so who they are, they're a top-rated financial services organization that was formed to serve Christians. So I don't know if that's an option for you. And you know what? If not, that's okay, because I have a few other options that we can talk about. At that point, stop talking, because they will let you know whether you can proceed, or they'll say, you know what, that's not for me. What else do you have? It's that simple. Don't make it any more complicated, any more convoluted. Don't get into a discussion about, you know, their church and their beliefs, anything like that. That is a road for disaster. Keep this very high level. Keep this simple. It keeps it non-offensive, because with Christianity, it's like going to Baskin Robbins. There's a ton of varieties, a ton of flavors. Not all of them are exactly the same. So keep it really high level. Position it this way. It's very non-offensive, and it works. So I hope I've shared a great story with you. And one of the things we do want to also extend to everybody who is on this call and that might be listening to the replay is to help you have another reason to give us a consideration. We understand we're not going to, you know, take over everybody's business that they're doing with other carriers. We just want an option. We just want a chance to be at the table whenever you're doing this. So take a look at us. And one of the ways that we encourage that is by having a launch incentive with Premier. So what we're going to do is for any Thrivent apps that are submitted between June 15th and August 15th, and that are enforced by October 15th. It usually does not take anywhere near that long to get anything issued, but because of COVID and stuff, we wanted to give a nice cushion here. So any apps submitted between those dates and enforced by October 15th, you will earn an extra $250 per life if the policy is enforced and paid by October 15th. So if you have a couple, both are issued, both are enforced by October 15th, that's an extra $500 in your pockets. There is no cap to this incentive. So if you love Thrivent's product and you want to just sell and sell and sell, you're gonna, you know, just keep adding on to that incentive. This incentive will be paid in November of this year. So I hope I've shared a great story with you today. As I said, there's no better time than right now to be adding Thrivent as an option, not just because of the underwriting considerations that we'll take a look at others, you know, that won't be looked at by others because of that face-to-face assessment requirement, things like that, but also because of the carrier strength. People appreciate hearing that, especially when, you know, there's fear about, you know, the economy, about recessions, about depressions, things like that. Again, there's no company, in my opinion, that is better weathered to, you know, or better suited to weather any kind of storm like this. So if you have any further questions on the Thrivent product, your first go-to is going to be the team at Premier Marketing. People like Katie are going to be, you know, all over helping you understand where this product fits, you know, get you the resources. We'll be following up this call today with a bunch of these tools that I talked about. You know, there'll be a copy of this presentation itself. I'll get to Katie. We'll get you a piece on any of the state differences, and again, on those differences from state to state regarding partnership qualification. We'll get you a copy of the underwriting guide, producer guide, all kinds of things like that. So at that point, at this point, Katie, do you have any questions that people have submitted?
I do. Just a couple of them. Most
Okay.
of them I think we've handled, but first one is, does the commission increase when the FIB premium increases?
I don't believe so. I'll have to double check on that one for you.
Okay. Next one, does a couple qualify if they are united using a covenant of marriage certificate?
Yes.
Another one was, does the agent need to be Christian in order to sell the policy?
No. Actually, we have a couple of, well, actually, even Thrivent's career agents, that's not a requirement. So they have people working within Thrivent Financial themselves that are not Christian, that are serving their Christian members, and yeah, it's not a requirement. You only have to be Christian to buy or be married to someone who is to buy.
Wonderful. Another one is, are the FIB options priced at original age or at attained age?
Each of those little buy-ups is at the attained age.
Okay. Another one is, are there discounts available to a current Med Sup client through Thrivent?
No, it's just going to be on their long-term care product.
Okay. Another one was, if you're already contracted to sell the Med Sup, is this a different contract?
This is, yep. And the Med Sups, I'm not sure where somebody is doing those, but you would want to get contracted through Premier for the Thrivent.
Well, I think that we have gotten the most of these. I will double check. If I missed any, I will be sure to address these in the email we sent. Again, I want to thank you so much, Craig. This was a great presentation. And to each and every one of you for taking the time to join us today. We are extremely excited. Please feel free to reach out. We're here to answer any questions that you may have. As you can see, our phone number is on the screen. You're also welcome to shoot us an email. And from there, I appreciate everyone's time and look forward to hearing from everyone. Thanks again, Craig.
All right. Thanks so much, Katie.
Alrighty. Take care, everyone. Goodbye.